Welcome to Growth Investing Mastery. Today we're going to review the earnings for the company Paymentus with symbol PAY. The company reported their Q1 2025 earnings on May 5th. As a reminder, this is not investment advice or recommendations to buy any stocks. The topics for this video will include looking at the guidance Pay gave versus the actual numbers they reported. We will take a look at the new guidance that Paymentus gave, and we'll review some of the numbers we learned about in the transcript. We'll examine the narrative from this earnings report, and lastly, we'll summarize our findings. Paymentus gave the following Q1 guides. They expected revenue to come in between 241 and 249 million. They guided contribution profit, a custom profitability metric, to be between 84 and 86 million. Adjusted EBITDA was guided from 24 to 26 million. Paymentus management also gives a full year guide for 2025, and that was from revenue of 1.04 billion to 1.06 billion. They expected contribution profit in the range of 358 to 366 million, and adjusted EBITDA in the range of 112 to 116 million. Let's now look where the company's results actually landed. They got revenue of 275 million in Q1, which was up 49% year over year. The top end of the guidance had been for 249 million, so the company beat the top end by 26 million, impressive achievement. Contribution profit was 88 million, and that was 2 million above the top end of the guide on contribution profit. Adjusted EBITDA came in at 30 million, which was up 51% year over year, and that's 4 million above the adjusted EBITDA top end of the guide. Overall, it seems like an impressive result, beating on both the top line and the bottom line. Paymentus gave new guidance as well, which we'll take a look at now. They guided revenue to be between 1.075 billion and 1.09 billion. That's up 30 million versus the previous guide. However, in this current quarter, they beat expectations by 26 million on the quarterly guidance. So this raise on the new full year guide isn't that impressive, actually. The range for contribution profit was increased by 3 million, making the new range 363 to 369 million of contribution profit. The new guidance for adjusted EBITDA for the full year was 118 to 122 million, and that's an increase of 6 million versus the previous guide. For Q2 of 2025, Paymentus guided for revenue of 255 to 260 million, which would be up 32% year over year. However, the current quarter just landed at 275 million of revenue, so this guide is for a sequential decline in revenue. Later, we'll talk more about how management says they have a very prudent approach on guidance. The Q2 guidance for contribution profit was 89.5 to 91.5 million, and adjusted EBITDA for Q2 of 2025 was guided from a range of 28 to 30 million. And I just wanted to add one more detail here, that the original full year 2025 guidance that the company gave assumed they were adding no new customers. And I was really surprised they were actually saying this, but they did say this in the last conference call, that the guide pretty much assumes it's just current customers producing and increasing revenue. Let's look in more detail at some of the numbers Paymentus put up for Q1 of 2025. Net income was 13.8 million versus 7.2 million a year ago, and adjusted net income was 17.6 million versus 11.8 million a year ago. Total transactions in Q1 of 2025 were 173 million, up 28% year over year, and adjusted gross profit was 72.6 million, up 25.9% year over year, and essentially flat quarter over quarter. And that is one of my concerns a bit, is that revenue is growing a lot faster than gross profit. So we'll keep an eye on this metric and see how it does going forward. Adjusted EBITDA was $30 million, up an impressive 51.3%, or growing faster than revenue. The adjusted EBITDA margin was 34.2%, a new record for Paymentus, and free cash flow was $41.1 million. Adjusted operating expenses were $45.5 million, up 13% year over year. And it's good to see that's growing much slower than revenue or gross profit. The company has $250 million of cash on the balance sheet and zero debt. Another interesting stat from this report was that share count is 128.8 thousand. That's versus 128.7 thousand last year. So there's basically no increase in share count. Let's continue taking a look at some of the numbers Paymentus reported. Over 50% of the year-over-year growth in contribution profit went to the bottom line. The company surpasses the Rule of 40 by a wide margin at 61%, and the average revenue per transaction was $1.59 in the quarter versus $1.37 a year ago. Contribution margin in the quarter was 31.8%. That's versus 33.4% last quarter and 37.5% a year ago. This is probably the most concerning trend from the earnings report. However, they did say that this contribution margin is offset substantially by the year-over-year reduction in operating expense margin. So things are getting cheaper from their side to run the platform. Days of sales outstanding improved to 33, down from 43 a year ago. And the metric measures the number of days it takes Paymentus to get a payment from their customer on average. One analyst noted that the free cash flow in this quarter was about 50% more than the company generated in all of 2024. Now let's examine some of the narrative that Paymentus told us from this latest earnings report. Paymentus serves the non-discretionary U.S. economy, as they put it, and they had strong exit backlog with solid bookings in the quarter. There is a diversified customer base with strength across verticals, and the CEO mentioned that water, electricity, and gas make up about half of the business. The company offers a better value proposition, and it resonates in all economic cycles. The company mentioned multi-year commitments give confidence for their CAGR model beyond the year 2025. This quarter saw prominent client signings in government agencies, along with utilities, telecoms, banking, credit unions, insurance, and education. Paymentus also signed a number of new channel partners in the quarter, and they said the results are driven by transaction activity coming from both new and existing billers. The company says we've now seen the second full quarter where we are seeing the benefits of these large enterprise customers, and they continued, it still exceeds our expectations. That's really impressive that the company is still exceeding their internal expectations that they set for onboarding large customers. The company said stronger adjusted EBITDA margin demonstrates the inherent operating leverage we have in the business. Continuing on with the Paymentus narrative, the company said they have the belief that our best is yet to come, and they base this on 5 different factors. The first factor was that they service the non-discretionary side of the domestic U.S. economy. Next, the company mentioned the great technology platform and ecosystem they have that scales up. The third factor is the record EBITDA margin they're seeing, yet top-line growth and margin expansion opportunities still exist. The fourth factor was a big customer base and partner ecosystem. Lastly, they said they have a phenomenal team of dedicated professionals. Management said same-store sales are growing nicely and in all verticals. They added, "We feel very good about where we are." One analyst noted that revenue is usually guided up, but this quarter is guiding for sequentially down revenue. The answer given was that large enterprises have not seen a full year cycle and that management wants to understand the dynamic carefully before making assumptions in their guidance. They did say, however, large enterprises are scaling beyond what we and they were originally expecting. There might be an upside to revenue, management said, and they're taking a prudent posture. Usually it's pretty rare for a management team to say there might be upside to revenue, but here they're kind of tipping their hat that we're going to beat this guidance pretty easily. The company says they're seeing no changes in business from macro concerns, and that's a reassurance to me with all the issues with tariffs and the trade war. Let's wrap up by looking at a few more elements from the Paymentus story. M&A is a secondary objective, and the company can be very selective, they say. It's a good organic business, and organic growth is doing very well. There's really no feature missing, as management put it. One direct quote from the conference was, "There's 2.5 billion in the bank account, and we're generating cash, and frankly, be in a strong position where our platform itself is driving the growth of the business organically, and we don't need to do anything." The company mentioned they're increasing working capital every quarter and seeing good EBITDA cash generation. It's the first time we've seen our cash to EBITDA ratio actually exceed 100%, management said. Management said that payment adoption is more mainstream now, and they can reduce the costs to serve clients. Opportunities exist for enterprises of any size, but especially the larger end of the market benefits the most from Paymentus solutions. One analyst noted that large enterprise billers outperform the internal expectations yet again. Management added that we've been converting more from paper processes to electronic processes is actually helping increase our TAM even within that same customer base, earlier than we were anticipating. They elaborated that channel partners have been a very important strategy in our go-to-market. Lastly, they mentioned large customers are getting better pricing, but that every customer is accretive to the bottom line or producing profits. Let's summarize what we've learned about the Q1 report of 2025 for Paymentus. The company had strong execution with large enterprises, which led to 49% year-over-year revenue growth. Some profitability metrics, such as gross profit, were flat quarter over quarter, while other metrics, such as adjusted EBITDA margin, set a record this quarter. The company reiterates it's only been 2.5 quarters of large enterprise pull-through. However, from my perspective, it's becoming a strong trend. The large enterprises now seem to be signing up quarter after quarter, and we'll see if the trend continues in future reports. Management seems really hesitant to bake in any upside to the guidance, and they constantly reiterate we're being very prudent. Overall, I found this to be a strong quarter with an optimistic commentary from the management team. My action plan is basically no action, and I'm going to hold my position as is. Paymentus is still a high confidence position for me. As a reminder, this is not investment advice or recommendations to buy any stocks. If you enjoyed the video, leave me a like, and if you have any questions, make a comment below. Thank you.